Welcome, everyone, to the FinWell Daily Brief. This is episode 67. It's Tuesday, June 24th, 2025. And just so you know, everything we're talking about today is based right on the market's closing data, fresh off the press. And to kick things off, we've got a financial fact that, honestly, it really puts the Indian investment scene into perspective. What have you got for us?
Indeed. It's quite remarkable, actually. Systematic investment plans, SIPs, they now make up nearly 9% of gross household financial savings here in India.
Wow, 9%. That's significant.
It really is. Think about that. Almost a tenth of how households are saving is now going through these SIPs. It paints a really vivid picture of a shift, a pretty profound one. It shows this growing preference among Indian investors, not just the pros, but everyday people too, for disciplined, long-term equity investment.
While moving towards wealth creation, not just saving.
Exactly. Moving away from maybe more traditional methods. Now, there's a small nuance, just to be completely clear. While the trend is strongly up, the overall SIP flows did moderate just slightly in the last quarter.
Yep.
Not a big warning sign or anything, but just something to keep in the back of our minds as we look at the bigger picture today.
Got it. And that SIP insight, well, it perfectly sets up what we're trying to achieve here today. Our whole mission on the FinWell Daily Brief is really to cut through all the noise out there. We want to unpack the key market moves, the big economic headlines from today, and just distill it down for you. Make it clear, concise, and hopefully genuinely engaging. Give you those insights, those aha moments, without feeling totally overwhelmed. So let's just get right into it.
Okay, let's unpack this then. The Indian markets, they have certainly had quite a day. If you were watching right up to the close, 3:30 p.m. IST today, June 24th, you definitely saw some action. Let's run through the main index numbers. The Nifty 50, our benchmark, it closed at 25,044.35. That's up 72.45 points, a gain of 0.29%. Solid.
Decent gain, yeah.
But, while the Nifty did well, it feels like the mid-caps and small caps were really the stars today. The Nifty Midcap 150, it closed strong at 21,523.05. That's up 151.75 points, or 0.71%.
Are we healthy?
Definitely leading the charge there.
And the Nifty Small Cap 250 wasn't far behind. It climbed 132.3 Toronto points. That's 0.78%, ending at 17,180.30 Toronto. And just to round it out, the Nifty Total Market Index, giving us that broader view, finished at 13,002.20, up 62.85 points, about 0.5%, 0.49%. So overall, a lot of green on the screen. But what about the wider economic signals? Were they moving in step with the markets?
That's a really good question, because you're right. These things don't happen in isolation. And what's quite significant is the stability we saw in some key macro indicators for India. Take the 10-year government bond yield. It stayed perfectly stable today, right at 6.36%.
Stable. Okay, what does that stability tell us?
Well, it might seem like a small detail, but its stability is actually quite telling. It suggests investors are, one, digesting the easing global risks pretty calmly, and two, they see domestic policy as steady, predictable.
Right, less uncertainty.
Exactly. For you, the investor, that potentially points towards lower borrowing costs down the line for companies, and just a more stable backdrop for longer-term investments. And there was more. The rupee also showed some notable strength. It firmed up to 86.04 against the US dollar.
Recovering a bit then.
Yes, recovering from recent lows. And this is really a reflection of improved global risk appetite investors feeling a bit braver, you could say. And crucially, it's linked to that retreat we saw in global oil prices.
Okay, so interconnected factors.
Very much so. So when you see a stable bond yield, a stronger rupee, these aren't just numbers on a screen. They reflect the underlying health and resilience of the Indian economy today. It paints a picture of a more robust financial landscape.
Those indicators definitely paint a positive backdrop. But now let's get to the really big story, the headlines that sent those ripples across the markets today, the catalyst. The huge news was that U.S. brokered ceasefire announcement between Iran and Israel. That just immediately dialed down the geopolitical tension meter.
A major development, yes.
And the effect on Indian markets, it was almost instantaneous and incredibly positive. Equities just soared. The Nifty 50 didn't just gain, it decisively crossed that big psychological number, 25,000. That's a major milestone.
A huge milestone.
And the Sensex, it surged over 900 points. The net result of all this, investors collectively saw their wealth increase by a massive rupees 5 lakh crore in just one day.
It's a staggering figure. Truly staggering.
How do we even put a surge like that into perspective, driven just by resolving some global worries?
Well, that's precisely it. It just underscores the incredible leverage, the power that these big geopolitical events have on market sentiment. It shows how quickly wealth can be created or sometimes destroyed when major uncertainties clear up. It highlights that direct critical link between global headlines and your own portfolio.
Absolutely.
And the impact wasn't just in stocks. This ceasefire sent immediate ripples through the commodity markets too. And that's a direct benefit for India. We saw oil prices drop sharply. Brent crude, the global benchmark, fell below $77 a barrel.
That's significant.
Very significant. It's directly tied to fewer fears about supply disruptions in the Middle East, which in turn makes investors more comfortable holding riskier assets, like stocks. And for India, being a net oil importer, this is huge. Lower oil prices should really help ease inflationary pressures. That affects everything from transport costs to manufacturing inputs.
Good news for inflation watchers then.
Definitely. And similarly, gold prices also reacted. They hit a 2-week low, with that safe haven demand fading after the ceasefire news because, when the world feels a bit safer, people don't rush to gold quite as much. 24-karat gold was trading around rupees 1,350 per 10 grams.
Down quite a bit from last week.
Yeah, down nearly rupees 700 from just last week. So for you, the listener, it's clear, isn't it? These global events, geopolitical calm, commodity price shifts, they directly impact your investments, maybe even your daily costs. It's a powerful reminder of how interconnected everything is.
It really is a direct line from global news right to your wallet. Now, while existing stocks were surging, we also saw some new activities, specifically in the IPO market. Let's shift focus to the buzz around Kalpataru Limited's IPO. It opened today. This is a pretty big offering from a well-known real estate developer. They're aiming to raise rupees 1,590 crore. The price band is set between 387 and 414 rupees per share. And we know the main use of the money raised is for debt repayment. That's fairly common. But what are the key things potential investors should really be thinking about here? Are there any red flags, maybe, that analysts are pointing out?
That's a really crucial question, host. Because yes, Kalpataru is a known name. They have a solid pipeline of projects, but potential investors absolutely need to look beneath the surface. Analysts have raised several pretty significant concerns. First off, the valuation. It just looks quite high.
High compared to others in the sector.
Yes, significantly so. The IPO is priced at a substantial premium. To give you a metric, it's EV/EBITDA multiple. That's basically comparing the company's total value to its operating earnings. It stands at an incredible 186.3 times its projected FY25 earnings.
Wow, 186 times. That sounds extremely high.
It is extremely high. It suggests you'd be paying a very hefty price today for future growth that might take a long time to materialize if it does at the expected rate. Second point, profitability, or perhaps the lack of it. The company's profit after tax, the PBT margin, was just 0.3% in the first 9 months of FY25, and return on equity, ROE, was only 0.4%.
0.3% margin. That seems razor thin.
Alarmingly low figures, really. It means for every rupee of sales or every rupee of shareholder equity, they're generating very, very little actual profit. It signals a potential inefficiency investors need to dig into. Third, as you mentioned, the high debt. The IPO proceeds are mainly for debt repayment, and the company does have a history of losses and also high capitalized interest. That basically means they've been borrowing heavily to fund things.
Okay, so debt is a major factor.
Definitely. Then you have execution risks. Real estate is complex. There are always potential delays, cost overruns in projects, both ongoing and planned. These could really hit future cash flows. And lastly, there's an extra layer of uncertainty. 2 of their planned projects currently don't even have the land rights secured yet.
That adds another risk element.
It certainly does. So the bottom line from analysts seems clear. This IPO looks suitable really only for investors with a very high risk appetite, who are looking long-term and who are willing to wait for potentially significant operational improvements and clarity after the listing.
Right.
So for you, the listener, understanding these red flags, these concerns is absolutely vital before even considering putting money into a new offering like this. You need to be aware of the potential downsides, not just the marketing pitch.
That's incredibly important advice, especially with the constant flow of new IPOs. Okay, so putting it all together, we have this market rally, the geopolitical shifts, calming things down, new IPOs with their own risks. What does it all mean for you, the investor, right now? Let's look at who's actually doing the buying and selling. We did see that Foreign portfolio investors, FPIs, they continued selling Indian stocks. Net outflows were rupees 1,874 crore on Friday. That's quite a bit of money heading out.
It is a significant outflow, yes.
And this seems crucial, there was a silver lining, right? Domestic institutions really stepped up.
They absolutely did. And that's not just a silver lining, host. It's really a testament to the growing depth and maturity of India's local investor base. The fact that our domestic institutions, our DIIs, could absorb that level of FPI selling, it shows our market is becoming less vulnerable to foreign flows, more resilient, more self-reliant.
That's a positive structural sign then.
I think so. So looking ahead, yes, Indian equities bounced back today because those geopolitical risks faded and oil prices dropped. That makes risk assets generally more attractive. And the Nifty crossing 25,000 is technically positive. It shows strong momentum, maybe potential for more upside.
But it's not guaranteed, obviously.
No, not at all. Further sustained gains, they're likely going to depend on seeing those foreign flows return more consistently, beyond just this initial relief rally. And perhaps even more critically, we need to see strong corporate earnings performance going forward. The upcoming earnings season will be key.
Right. Fundamentals still matter.
Always. So for investors wondering where opportunities might lie, potentially, sectors like real estate, infrastructure, maybe some select mid-caps could see renewed interest if the economic activity holds up. But again, I have to stress caution around those high-valuation IPOs like the one we just discussed, and any companies that are heavily leveraged, meaning they have a lot of debt.
So what's the advice?
For you, the prudent investor, the advice remains pretty consistent. Focus on quality companies with strong fundamentals. Maintain discipline in your portfolio. Don't chase rallies blindly. And keep a close eye on both the global cues and the domestic economic data for direction. Informed discipline, as you said earlier.
Informed discipline. I like that. It's a good mantra. And speaking of market dynamics and, sometimes the less savory side of things, this feels like a good moment to talk about a tactic that investors should really be aware of. It can unfairly mess with market movements. Have you ever heard of something called a bear raid? It sounds dramatic, almost like something from a movie.
It does sound dramatic.
But it's a very real and, frankly, quite dangerous market tactic, something every investor should understand to protect themselves.
Yes. This is a crucial beware moment, absolutely. Understanding these kinds of deceptive tactics is so important for protecting your hard-earned money. So, a bear raid, essentially, it's a manipulative strategy. What happens is traders will aggressively short sell a particular stock. That means they're placing big bets that its price will fall.
Okay, betting against the company.
Exactly. But here's the insidious part.
Yeah.
At the same time they are shorting it, they deliberately start spreading negative rumors, maybe false information, about that company.
Ah, so they're actively trying to make the price fall.
Precisely. Imagine a group secretly wagering against a stock, and then, to try and guarantee their bet pays off, they actively circulate fake bad news, misleading reports, anything designed to create panic among other investors.
To trigger selling.
Exactly. The goal is simple. Drive the stock price down, cause panic selling, artificially depress the valuation, and then the raiders can buy back the shares cheaply to cover their short positions and pocket a handsome profit. It's pure manipulation.
That sounds incredibly unethical and potentially illegal, too.
It certainly skirts ethical lines and can cross into illegal market manipulation depending on the specifics and jurisdiction.
So how can you, the listener, protect yourself from getting caught up in something like this?
The most vital piece of advice is this. Always, always verify news and information. Use official, credible sources. That means regulatory filings like from SEBI, official company announcements, reports from reputable financial news organizations.
Don't just rely on social media or chat groups.
Absolutely not. And just as importantly, avoid making impulsive trading decisions based only on rumors or unverified tips you see floating around online or hear through the grapevine. Being aware that these manipulative tactics exist isn't just about knowing things. It's about empowering yourself to stay calm, make rational decisions based on facts, and directly protect your financial well-being.
That is a really powerful reminder. Stay vigilant, stay informed, verify everything. Okay, let's quickly recap the main points from our Finwell Daily Brief today. We saw a strong rally in the Indian markets, mostly thanks to easing global tensions after that ceasefire news, and also the welcome drop in oil prices. Nifty crossed 25K.
Big day for the bulls.
We also took a close look at the Kalpataru IPO that opened today, really highlighting those significant valuation concerns, and execution risks that warrant a very cautious approach from potential investors.
Definitely one for the high-risk category.
And the key takeaways for you: focus on fundamentals, quality companies, avoid chasing rumors or making trades based on unverified information, be wary of things like bear raids, and always exercise extra caution with those high-risk, high-valuation IPOs. If you found today's discussion helpful, please do subscribe to the Finwell Daily Brief wherever you get your podcasts so you don't miss future updates. And for more insights and connection, you can find SOS Finwell on LinkedIn. Feel free to connect with us there.
And as we wrap up today's Finwell Daily Brief, perhaps a thought to leave you with from Henry David Thoreau: wealth is the ability to fully experience life.
A great quote to reflect on. And finally, please remember, this podcast is strictly for informational purposes only. All the market data we discussed comes from SEBI-registered exchanges and official regulatory filings. It's crucial that you always consult with a certified financial advisor before making any investment decisions. Thank you so much for tuning in today. We look forward to joining you again soon.